My name is Peter Renton, and I'm the chairman and co-founder of Fintech Nexus. We're just getting the finite number of mics have to be exchanged from panel to panel, so there's a short break here, but I think we're just about ready to go. And as Phil said, this is a hot topic. AI is one of the hottest topics of the year, and we are going to be talking about not just AI, but about alternative data. And with that, let's start off with some introductions. Marty, I will start with you. Thank you, Shannan, for joining us. I know you were the last one mic'd up, but Marty, why don't you give us a quick intro about what you, I think everyone knows what Prosper does, but just tell us about what you do.
Sure. My name's Marty O'Malley. I'm an assistant general counsel at Prosper. I cover all things borrower facing, so borrower regulatory, borrower litigation, and government affairs. So if it involves a person, a human, it comes through me and my team.
Kareem?
Hey everybody, Kareem Saleh, founder and CEO of FairPlay. We automate fair lending testing and reporting for many of the fintechs and sponsor banks in this room.
Lynn?
Great. Lynn, Sautter, Beal, Vice President of Lender Services at Upstart. So my team works with all of our bank and credit union partners, implementation, customer success, diligence, and supporting their regulatory exams and regulatory needs.
Shannan?
Hi, good afternoon. Shannan Herbert. I'm EVP of Inclusive Credit with Stratyfy. We are a mission-focused fintech that works to promote financial inclusion through the use of our technology, primarily working with community banks, CDFIs, and MDIs.
Okay, so let's kick it off by giving just the state of play of where we are when it comes to AI and alternative data. Lynn, why don't you kick us off?
Great, thanks. So I think it says a lot just that there's this panel of us up here, all the people in the room, of course, here to listen and engage on this topic. And then, of course, a conference going on in Austin focused on CRA, inclusive credit, special purpose credit at the same time. I think as we think about access to affordable credit, there's really two considerations. One is the access, and two is the affordability. So if you look at the data and traditional kind of credit scoring models and credit reporting, there's roughly 20-ish, a little over 20 million people who do not have any credit history at all in the US. Then you have an additional, say, 28, 30 million who have a thin file and are maybe either unscorable or have a kind of a bare minimum score report. So those folks in many ways are kind of left out of access to credit, so don't even have the ability to access credit. And then really the second issue that we spend a lot of time talking about at Upstart is this idea of invisible primes. So those people who have not defaulted on a debt, do not have poor credit history, but maybe can't access credit, or if they can, they're accessing it at rates that you could consider unreasonable. So I think the opportunity that we have collectively is to think about both expanding access to credit and also then offering it at more reasonable, affordable rates while managing the risk for our clients.
Mm-hmm. Okay. So, Kareem, I'd like to turn to you, and a lot of lenders have, I would say most lenders have tightened their credit boxes in recent months over the last year, shall we say, and that I think it highlights the potential of AI and alternative data. So, what is the role for AI and alternative data?
Yeah, well, let's just start with the premise that we're in one of the most difficult underwriting environments ever, right? We've got price inflation, we've got rising interest rates, we've got the resumption of student loan payments, and we've got credit score inflation owing to the various government interventions into the economy during the pandemic and then the subsequent prohibition on negative credit reporting. So if you are a lender who's tightening your buy box, and if you're a lender who's heavily dependent on conventional credit scores, let's say like FICO, we know that those scores are overfit to the majority population. And that the distribution of those scores is lower for various historically disadvantaged groups. And that means that you may not be those scores don't fully capture both the circumstances and the capacity to pay of many consumers and many loan applicants. And so in an environment like this, what you need more than ever is the ability to get as close to the consumer's balance sheet as possible through things like alternative data and through things like more predictive analytics. So it's no surprise that we have seen the growth of cash flow underwriting the last several years. We've seen the incorporation of alternative data elements like rental payments, utility payments, trended data, and then the ability to combine that with analytics that allow you to use that data to paint a much finer portrait of a borrower's ability and willingness to repay a loan. So I think that in an environment like the one that we're currently in, folks have to be very, very nimble, both with respect to the data sources they're using and with respect to the math they're using in order to navigate what is going to be a very challenging credit environment.
Right. So, Shannan, I want to turn to you and talk about underwriting, and because we have some of the new data elements that Kareem just mentioned, but to take advantage of those, you really need to change the way we think about underwriting. So, how should lenders be changing things up?
Well, I think the first thing to do is ask yourself why you're changing things, right? We could sit here and say we're going to change credit score thresholds, or we're going to change our debt service coverage ratio thresholds, but without really knowing why and who it is that we're trying to reach, we're just changing data points and not really hitting those targets that we're trying to hit. One of the things that we've been really focused on is working with a group of lenders through our Underwriting for Racial Justice Lender Pilot Program, helping them change their underwriting guidelines and their underwriting practices, but we're doing it in a very measured approach. We're taking a very measured approach to this, understanding who they're serving now and who they're trying to serve through their underwriting, and then helping them through those predictive analytics come up with those new guidelines. Because one of the things that is really important to this program and to us is making sure we have the customer voice in the decisions that we're making. So we can do everything internally and present it to the borrower. If that's not what the community wants, they're not coming in the door. They don't want that. They didn't ask for that. So let's get the community voice involved, and then we can create programs, we can change those guidelines to better meet the needs of the customer. I'll give you a quick example. We have one lender in the cohort that created a women's entrepreneur loan program, and then they created a Black women's entrepreneur loan program. Why is that important? Because we know that Black women start more small businesses in this country than anyone else, yet more than 50 or 60% of them have to self-fund. So what this lender did was go outside, get those outside sources or outside feedback, and then let that inform the loan program that they created.
That's really interesting, really interesting. Okay, so Marty, I want to turn to you and talk about Kareem mentioned it, it's a difficult environment. You're on the front lines. How are you calibrating your models at Prosper?
Yeah, it is a difficult environment, and this is one of the first time that fintechs have been tested in a down cycle or in a choppy credit cycle. And so, as in all things, fintechs have to be really responsive to what's happening in the market. And so what we do is you look at each stage of the cycle, whether it's customer acquisition, whether it's marketing, whether it's underwriting, whether it's fraud and verification, whether it's collections, and you can use models in each of these stages to refine and to try and understand where your customer is, what do they want at the marketing stage. At your credit underwriting stage, you can bring in, as Kareem alluded to, additional variables, additional ways of thinking about it besides just a blunt credit score, which really is not going to get you close to your customer. You really want to drill down and find and segment and figure out who your customer is. Then you want to move on to fraud and verification, and you want to use the tools that are available and really refine those models to figure out, is your customer even really a customer, or are they some identity that's sourced from the internet and is posing as a customer? And then finally, it turns out that not all credit decisions turn out to be perfect. And then you want to figure out, of those imperfect decisions, how can you help that customer? What can you do to help that customer move on in their credit life, give you some return, because the company still needs return so that we can start all over again with the next customer. The closer that these models can be refined, calibrated, back-tested, checked against their limits, refit, reused, rebuilt, relaunched. All those things can be done so tightly to keep the liquidity flowing through the system so that we can serve these customers.
So is it possible to keep the liquidity flowing when the models might be demonstrating that your loss rates are going up significantly?
Yeah, it really comes down to customer segmentation. So your models have to inform your segmentation, which have to inform your pricing, which have to inform your loss rates, which have to inform your returns. So each of these has to be looked at individually and also as a whole, because it has to work for everyone. The system can't break down for the customer or for the investor or for any of us. Because if the system breaks down in any one spot, then it can't come back through around. The way we can get access to and fair lending to customers is to have that capital to deploy to reach them.
Right.
You know, Peter, picking up on something that my colleague said here, I'm struck both by what Marty said, which is the need to use these models across the customer journey, everything from marketing to fraud detection to underwriting to pricing to account management to loss mitigation in order to get their benefit. And also what was said earlier with respect to, so there's A, the need to use them across the customer journey. B, there's the fact that like the models and the data don't accurately reflect stress conditions, right? We've basically been in a zero interest rate environment for the last 15 years, a largely benign credit cycle. And so like stress testing the models has become more important than ever. And then recognizing that certain data elements might have different predictive power for different groups. So for example, the example was given earlier about, email loan applicants. And I'll give you an example of a variable that we see all the time in credit underwriting models, which may require some adjustment in an environment like this, is consistency of employment. And if you think about it, consistency of employment is a perfectly reasonable variable on which to assess the creditworthiness of a man. But all things being equal, right, consistency of employment is going to have a disparity driving effect for women who take time out of the workforce to start a family. So it feels to me like AI and big data are more important than ever. And yet, you've got to be really careful when you're applying these tools across your business, because if you do the wrong thing, they might run your business off a cliff.
Right. So Lynn, I want to turn to you, because obviously at Upstart, you guys have been using AI for, I think, probably close to a decade now. And now you're actually working with banks and credit unions as well, who, are traditionally more cautious with new ways of underwriting. So how are you getting those types of financial institutions comfortable?
Sure. So I think the interesting thing about what we do is we do work with, we're over 100 lenders today. I know we had a lot of conversations earlier about what's the right number, but we are over 100. We do have some marketplace lenders. We have some traditional bank and credit union partners who originate and retain those loans. And because of that, there are also a wide variety of sizes and sophistications, a wide variety of regulatory regimes that oversee them. And so we're spending a lot of time on education and really helping them understand how we do what we do. And particularly in our kind of risk and compliance partners, continuously kind of reviewing, revising, improving our policies. And then really on our team, on the lending partnership side, we've had a key initiative this year called regulatory readiness. And we're thinking about not just how do we get them to say yes to partnering with us, but how do we support them and prepare them for that exam. So really providing as much kind of model documentation, model risk management, model construction, writing that out in a playbook that lenders can use and then can reference, and then really kind of being there to partner with them to support them through those exams. And for those smaller lenders that don't have as much experience, where we may be the first fintech that they've worked with, providing those best practices. Here's what we've seen for oversight. Here's what we've seen for documenting your diligence. So not just doing those things, but really providing evidence for them so that you can pull them out and kind of show your work to the regulators.
Mm-hmm. Okay, so let's switch gears. I want to talk about adverse action notices, and this is something that there's been a lot of talk. It was a really hot topic probably 3 or 4 years ago with explainability, and it seems like that it's no longer the hot topic of the day, but I'm still curious about, like, Shannan, maybe this one's for you, where you can talk about how lenders are getting comfortable with, with adverse action notices and that are coming out correctly from their AI models.
Yeah, so I think this is an opportunity where we can use technology to change the way that things have been done previously. There are times when I'm doing community events here locally, and I'll sit on a panel and someone will find out that I was a former banker or still bank adjacent. And so the first thing they want to know is, okay, I applied for this loan and I was turned down. I was put through an algorithm and they told me I was denied and no one told me why I was denied. I don't know how to improve things. And so I get one of two responses. Either I'm fed up with the system and I'm not going to apply anymore, I'll just do it myself. Or what can I do to improve? I think the what can I do to improve piece is where we have the opportunity. So instead of the no, you'll get a letter in the mail, figure it out, it's a not yet. So no, not yet, here are the things you need to do to become bankable, and then we can consider you or pre-qualify you for something down the road. It's a much more compassionate way to work with borrowers. Compassion and finance typically don't go together, I know that, but it is a much more compassionate way to work with customers, but it's also a way to build trust, right? When we have 6 million people in this country that are unbanked, and trust being the number 2 reason why these people are unbanked, we have a responsibility to help bring everyone in. So having these models that are explainable and transparent so that the lender can then have those conversations with their customers to show them where improvements are needed and how to get there, but then also making resources available to help them get there through technical guidance or some other form of assistance. This is what some of the lenders are doing in our cohort, and we've seen that be really effective, especially in communities of color.
Interesting.
I want to jump in here. This is an area where your lawyers and your compliance professionals are truly your best friends. And my team works very closely with our data scientists when the models are being built. We look at each variable to see whether or not that variable is acceptable for use. If we have concerns about it, I would say without exception in my time at Prosper, the data scientists have said, if you're worried about it, I'd rather not use it. They'll take it out of their model. So then once you arrive at a set of variables that you think are okay, if it's an underwriting model, each one of those variables has an adverse action reason associated with it. And I have to tell you, it is a labor, in my mind, of love over those reasons, because we look at those inputs and we say, are we accurately describing this? Are we giving the information to the customer so that they'll know what this means? They'll know what they need to do. And sometimes those variables come in these ways that you're like, I don't even know what that means. And so I'll ask the data scientists, go find out what that is. And they come back and they tell me, and I'm like, okay, now I'm going to translate that into an actionable message so that the consumer gets it and knows what it means. That gets built into the model, and it goes through my team, it goes through risk oversight, it goes through our bank partners. It comes back so that everybody can see what these adverse actions reasons are, and when they go to the consumer knows what to do with them. It's really critical with your models in particular.
So then are you providing guidance to the consumers when they receive that adverse action?
In the form of their adverse action notice, we sure are.
Peter, just one last point on adverse action, because you said, well, this was an issue this was a kind of hot topic a few years ago, but hasn't been really in the news much lately until this recent statement. And I think the reason that it sort of had died in prominence was if you went looking for, cases or consent orders where folks had been sanctioned for giving improper adverse action reasons, up until very recently you couldn't find them. Right. And we've had like 2 in the last quarter. Mm-hmm. So it's clear that the enforcement landscape around adverse action is evolving.
Right. So let's talk about another thing, something that is a hot topic and has been in the news just in the last couple of weeks, and that's CRA reform, right? So we have a new regime that's happening. It's now taking into account a lot of the lot of the advances that fintech has made over the last decade, and codifying that. So, how will maybe Kareem, you can tackle this one. How will fintechs really help implement this new regime that's coming up with the new CRA?
Yeah. Well, so for folks who may not be aware, the way that CRA used to work was that banks, the investments that banks were making in low and moderate income and majority minority neighborhoods was assessed essentially by their physical footprints. And what this new version of CRA modernization does is it makes your assessment area based on your digital footprint, not merely your physical footprint. And so what that means is that you may be not physically operating, banks may be not operating physically in certain communities, but might occasionally originate some loans in some place that they get via some online channel, and now their commitment to the communities in those places where they're sourcing those loans electronically is going to be reviewed. And it seems to me that fintechs have a very important role to play here in helping banks kind of survive in this new CRA reality, because definitionally the fintechs maybe help to serve customers that you yourselves couldn't reach as a bank, especially a bank that maybe is limited by its physical footprint, maybe limited in its digital marketing capabilities, and so on and so forth. So I think CRA modernization presents another great opportunity for bank fintech partnerships, and done right can be a driver of inclusion, because they can help you build underwriting models that are sensitive to these communities that you may not have historically served or may not have historically served well, and pay a regulatory and reputational dividend.
Mm-hmm.
Can I add something to that? The new CRA specifically calls out special purpose credit programs as a way for banks to receive CRA credit. And fintech can help with special purpose credit programs. This is something that we have focused on at Stratyfy with the underwriting and changing the underwriting for the lenders that we're working with. You can change the underwriting to fit a special purpose credit program and still fit within those CRE regulations. So I would encourage everyone, if you haven't read all 1,500 pages of the final rule, to read it, but understand what these tests look like, the community development test, what that's going to look like, and then how you can think creatively about meeting the needs of LMI communities, but special purpose credit programs is something that everyone should consider.
Mm-hmm. Yeah, I'm just touching on the LMI communities, Shannan. We had our prep call last week, and you touched on this, and the human touch, which you don't very often hear in a fintech panel. So I wanted you to expand on that, and how can we balance the technology innovations which have been vast in the last decade, but with the human touch that you talked about?
Yeah, I think you have to have the human touch. Right? You don't want the machines to just run off on their own. You have to have a human present, especially when you are working with communities that may have suffered through financial harm, may have suffered through financial trauma. The last thing you want to do in this quest to build trust is to let a machine do the work of the human, and to take again, I'm coming back to this word, compassion, to take the compassion out of the process. So I think that when you have a model that you're deploying or any sort of system that you're using, it needs to be transparent. It needs to be explainable. We have invited all of the lenders to basically look under the hood. Okay, this is how it works. This is how we're helping you make these decisions. These are the outcomes. Let's fine tune this so that it makes sense for your customer base and for your risk profile. And so I think it's really important to have that element involved. Not just from a lender and fintech relationship, right? You definitely want to have that there. You want to have that trust. But lender to community. So who's the end user? And we have to keep that front of mind. There's someone on the other end of all of these decisions that we're making. There's a community. There is a customer. There's someone that needs our help. And if we keep that person in mind as we're making these decisions, I think that we'll make much better decisions, and we'll approach the modeling and all of these business decisions in a different way. I think a different way that honors the people that we're trying to serve.
But are you arguing then that we shouldn't have automated underwriting at all? Or is that, how
No, I think-
how do you reconcile that?
I think you should have automated underwriting, but I think you still have to have a human as part of that, either through a review process, a test process,
Right.
someone to translate what is being, what's being shown through the model. I can tell you from personal experience, so again, I mentioned I was a banker for about 23 years, and I was chief credit officer for a local CDFI, and models would come before me all the time, black box models. I couldn't explain what was in these models. I have a finance background, not a technology background. So you give me a model and you tell me that these things this is a score for this. Where did you come up with this? Because I can't explain this to my regulators. I can't explain this to my board. And if we have to explain these things to customers, we can't. So I need to be able to explain it. I need to be able to understand it. It has to be accessible. And so that's where the human part comes in. Have it open book. Now we can have a conversation around it to see if it's working properly, and we can explain it to our regulators because they want to know too how these decisions are made.
Yeah, it was interesting when we talked about this last week. I kind of had the same thought as Peter. How do we put the human in the loop while automating and building for scale? And as you were talking, Shannan, I was thinking about how we support our lenders, how we support our bank and credit union partners, and they very much care about the consumer experience, especially the ones that are originating and retain. And for the partners we work with who are lending in their local communities and may have other kind of community resources that they're involved in. One of the things that we've done is not just show kind of adverse action, but show explainability, like underwriting transparency, helping that lender be able to self-serve why we approve somebody, in addition to, for those people that were not approved, why they were declined. And I think making that information available to them, and then making available any of those kind of notes, information, and service, whether it was in onboarding or servicing, helps our lending partners really put that human touch into a digital experience.
Absolutely.
Right, and so Marty, I mean, Prosper is now almost 18 years since you first originated a loan. That's an eternity in fintech, and so as you're hearing this conversation, I'd love to kind of, you to comment with the institutional knowledge that you've gained in 18 years of tweaking underwriting models, and with automation, human touch. What do you feel that is, important? How is Prosper kind of maintaining their responsible lending? How are they really doing things, taking all this into consideration, but taking also your accumulated, knowledge that you've gained?
That's a great question. I mean, Prosper has been at it for a really long time, and we've gone through a couple of different incarnations. We began as a direct lender. We are no longer a lender or an originator or a funder of credit. We're in a bank partnership model now. So our partner banks are the lenders in our products. But based on time, we have realized that it's important that you can't chase. You can't always chase the upside all the way to its end degree, because then inevitably you'll suffer the downside. You can't chase certain pockets of credit. Inevitably that pocket of credit will turn in some way that's adverse to you. What you can do is you can build models that will allow you to segment and allow you to serve consumers across varying degrees of credit risk. And then you can calibrate your product, depending on what that product might be, to incorporate, to your point, more and less important levels of human intervention. So some products can be more closely automated, where they have straightforward credit decisioning that is overseen, supervised, approved by your lending partner. Some products are more complicated. They may have a longer term. They may involve more manual underwriting or more manual verification. Those products involve a person talking to you, reviewing your sources of income, reviewing what you can do to make sure that you actually qualify for this product. Because if you don't qualify for the product and we try and jam you through it, it will turn out poorly for you and for the customer. No one wants that result.
Right.
And we have other products that involve very high level of customer touch. And these products, really we have to talk to you. We have to figure out, what is it that you're going to do? What is it that you want this for? What are your documentations? So it really, your level of models, your level of AI, your level of manual human interaction really depends on what the product is and where the customer is in the credit spectrum.
Okay, so last topic I want to touch on here, that was the executive order on AI that came out of the White House. I think it was just last week. It was the week before. It was really recently. It mentioned bias a number of times, and maybe Kareem, could you comment on that? Like, what does this clarify anything for lenders?
Yeah, all you have to do is look at the most frequently reoccurring words that are used in the executive order. So the executive order by the numbers mentions discrimination 25 times. I think it mentions bias 9 times, red teaming 10 times. There's a handful of other terms, but it's very clear that the administration is extremely concerned. I think in part, because of the way that ChatGPT and generative AI has kind of captured the public imagination, that these AI systems pose near-term threats in terms of both bias and hallucination and discrimination across a variety of domains, including financial services. And while there aren't new requirements in the EO, they do kind of reaffirm their expectation that there's going to be regular bias testing and regular monitoring of these systems when they're in production, so that institutions can be assured that they don't pose a threat either to the safety and soundness of their firms or to the consumers that they serve. I will add that the EO also contemplates a future where federal regulators are themselves using AI. And if you think about AI as being kind of like the great equalizer, imagine for a minute what it would mean for your regulator to be able to have an army of bots at their disposal to supervise your activities. I was once told by a very senior guy at the CFPB that the entire investigative capacity of the CFPB at any one time is 150 investigations. What's that number going to be in a world where the CFPB has access to an infinite number of robots? Is it going to be 10x the number of investigations? 100x the number of investigations? I don't know, but it's really something to think about. Yeah.
Yeah, I don't know if you've ever had to sit through a regulatory exam, but robots looking through your financial records sounds really scary, and that's not anything I think anyone wants to experience. But I think that what is apparent is that we need to make sure that the folks that are regulating the financial institutions have an understanding of the technology. And that's the part where I'd like to see a little bit more guidance in terms of what the standards are for the examiners when they're coming in. Do they know what to look for? Do they know the questions to ask? Because I think that helps the financial institutions be better prepared on the back end when they're having to go through those very stressful examinations.
Yeah, I think that's a great point. We talk a lot about how anytime any sort of clarity is good, and so we would rather see more clarity than not. At least it gives kind of clear rules of the road for ourselves and to help support our lending partners.
Right. Okay, we'll have to leave it there. Thank you very much, all the panelists. That was a fascinating conversation. Give them a hand.